When people are getting a mortgage, they often just shop around for the best rate. But the truth is that getting the best rate does not necessarily mean that you are getting the best mortgage available to you. And in this video, I will be going into how understanding the basic mortgage terms, what they mean, and how they matter to you can save you lots of money and headaches down the line. So let's start this money talk with some basic mortgage terms. The first I'd like to talk about is a term. A term is a period when certain characteristics of the mortgage are in effect, such as the interest rate, whether the rate is fixed or variable, whether the mortgage is open or closed, or what are the prepayment privileges and penalties. During the term, you must stay committed to the same lender and the same conditions of your mortgage. A typical term in Canada is a 5-year term. Recently, at the end of 2022 and now at the beginning of 2023, a 2-year and 3-year terms became very popular. Lots of borrowers are now taking shorter terms while waiting for rates to be more attractive again. When you take a new mortgage with, let's say, 5-year term, at the end of this 5-year period, your mortgage will not be fully paid off. There will be an outstanding balance and you will have to renew your mortgage to a new term. At renewal, you have 2 options as to which lender you want to work with going forward. You can stay with your current lender. If you like their services, you like the rate they're offering you for a new term, you can stay. But if you don't, you can leave them and you can find a new lender. And this is exactly the moment where I would highly recommend you to work with a mortgage agent. Find a mortgage agent and discuss your options. They can save you a lot of money. The next important term to understand is amortization. Amortization is the total amount of years it will take you to fully pay off your mortgage. A typical amortization in Canada is 25 years. If your down payment is lower than 20%, your amortization cannot be longer than 25 years. If your down payment is greater than 20%, you can get an amortization of 30 years or even longer. Now, I want you to know that the length of amortization has a direct impact on your money. It affects your buying power, it affects your mortgage payments, and it affects the total interest paid over the life of your mortgage. The longer the amortization, the higher your buying power. The longer your amortization, the lower your payments. But it has a flip side as well. The longer the amortization, the more interest you pay over the life of your mortgage. I want to show you a live example how the length of amortization can affect your money. Here we have a $500K mortgage with a 5-year term and 5% fixed rate with a 25-year amortization on the left side and 30-year amortization on the right side. As you can see, the payment of a mortgage with 30-year amortization is $240 lower, which is great, but the lifetime interest paid on this longer mortgage is $88,236 higher. Now, $1 million question. Which mortgage is better? Is it fixed rate mortgage or is it variable rate mortgage? A fixed rate mortgage is exactly what it says. It's a mortgage where the rate is fixed for the duration of the term. Practically, if you get a fixed rate of 5% for a 5-year term, it means that your rate and your payments will remain the same for 5 years. Once your mortgage is up for renewal, your rate might change. The biggest advantage of a fixed-rate mortgage are stable and predictable mortgage payments. There are no surprises, and this simple fact can give you peace of mind. The negative side of a fixed-rate mortgage is that when you break your mortgage during the term, the penalties could be quite high. Another disadvantage of a fixed-rate mortgage is that you cannot convert it to a variable rate mortgage. When you start with a fixed rate and variable rates are at some point of your term much lower than fixed, you cannot do anything until your mortgage is up for renewal. A variable rate mortgage is a mortgage based on a rate that is not fixed. The rate fluctuates and adjusts every time when the Bank of Canada changes interest rates. The rate has a direct impact on mortgage payments. This can be a clear disadvantage for people who want to pay stable mortgage payments. On the other hand, the penalties to break a variable rate mortgage are much lower and worth considering when you do not know how long you are going to own the property or you are planning on upsizing or relocating anytime soon. And another advantage of a variable rate mortgage is that it can be converted to a fixed rate mortgage. When choosing between fixed and variable rate mortgage, it's all about you, about your personal goals, your financial goals, and your risk tolerance. And ask yourself a question: which mortgage would give you and your partner a peaceful sleep at night? And choose the one that will not negatively affect your life. It's that simple. And now let me explain what an open and closed mortgage is. This explanation is relevant to you if you want to pay off your mortgage faster. You definitely want to know if it's possible or not. An open mortgage is one that has no penalties when you choose to prepay. Open mortgages are open to prepayment of any amount and at any time. Open mortgages are more flexible but have higher rates. A closed mortgage allows you to prepay between 10% to 20% of the principal each calendar year. Your lender will determine the amount you can make per year, and if you exceed the limit, there will be prepayment penalties, which can be costly. If you want to pay off your mortgage faster and your lender gives you prepayment privileges, you may use one of these options: annual lump sum payments, increased mortgage payments, payment frequency change, and double up payments. And let me show you how much you can possibly save when you make a prepayments. Starting with lump sum payments. These are the extra payments you can make on top of your regular payments without paying a penalty. Lenders will typically allow you to make 10, 15, 20% of the mortgage amount. You need to read the fine print of your contract to find out what is the percentage you were granted and the percentage of what mortgage amount, the percentage of the original mortgage amount or the current mortgage amount. A lump sum privilege is a great tool for those who receive a bonus or inheritance and want to put money into their mortgage. The second option is to increase your mortgage payments on a few first anniversaries. Just make sure you can handle the increased payments. This strategy can save you lots of money on interest over the life of your mortgage. The third option is to change the frequency of your payments. Typically, people go with monthly payments, but if your budget allows you to change it to an accelerated payment, either bi-weekly or weekly, again, it can save you time and money. One of the fastest ways of paying off your mortgage is to double up your payments. This tool is a hybrid of lump sum payments and increased payments. On any payment date, you can lump sum a payment that matches your regular payment. Again, a great tool that saves you lots of money. According to statistics, more than 60% of mortgage holders break their mortgage during the term. Most of the mortgages with 5-year term will not survive their third anniversary. So it's absolutely essential for you to know how much it's going to cost you when you break your mortgage. If a borrower breaks their mortgage, the penalties can be costly. Bank penalties are often 3 to 5 times higher than penalties charged by lenders specializing in mortgages. So if you get a mortgage from a bank, be aware of the risk of paying significant penalties. If you want to protect your money, consider working with a mortgage agent, as they have access to a variety of lenders offering more friendly penalties. These are the 3 types of penalties you might be possibly paying: the flat rate penalty, 3 months interest, and interest rate differential. Let's now talk about each of these. The flat rate penalties are calculated as a flat percentage of the mortgage amount. If, as an example, the penalty is 5% and the mortgage amount is $400,000, then the penalty would be $20,000. The second type of penalty is a 3-month interest penalty. This penalty is typical on non-discount variable rate mortgages, and this type of penalty is the most forgiving. When you have a fixed rate mortgage, your lender will charge you a higher of 3 months interest penalty and an interest rate differential, which is the amount the lender will theoretically lose if you break your mortgage. This penalty can be really high, and you should be aware of it when taking a fixed rate mortgage. And now I'd like to briefly talk about mortgage rate. I saved this topic to the very end just because I wanted to show you what else is important when shopping for a mortgage. I wanted you to know how other features like term, amortization, prepayment privileges, and penalties, or how deciding between fixed and variable, open and closed, can play an important role in choosing the best mortgage for you. And yes, the rate is important, and choose the rate you will be satisfied with. But do not put the rate ahead of the other features of your mortgage. You will need that flexibility to make changes to your mortgage whenever you have an opportunity to save money. I hope you found this video helpful, and if you'd like to talk more about how I can possibly help you to purchase a home or help you with financing your purchase, use the link in the description of this video and book a call with me. I would love to talk to you. Thank you for watching and have a great day.